Okay guys, welcome to the channel. So today's video is going to be more of a portfolio review, and we're going to be taking a look at my best and worst investments. And considering the macro environment of the market right now, as well as my inopportune new additions, there's definitely a lot of pain currently in my portfolio. So I'm going to turn that frown upside down, monetize my pain, and I hope you guys enjoy. So the first bit of news here is that we officially passed 1,000 bucks in earned dividends. And that's courtesy of my one closed-end fund, BST. They have managed distributions, and because of that, their ex-dividend date is pretty early. So with this new monthly dividend of 25 cents, considering my position size, this is a monthly dividend of $29.60. And looking back at the previous month, this is the same exact dollar value because I didn't add to my position. But aside from the dividends, overall, we are down 1,200 bucks in capital valuation. And even considering the dividends and the total return, we're still down overall 0.91% at the current moment. And the major reason for this is because I recently made this pivot to an ETF heavy approach. I made a dedicated video on this topic, so go check it out if you're interested. But from the time period of October through about November, that's when I sold all of my individual stocks, and I put that capital into these new ETF positions. Now, I did have pretty solid gains in most of my individual stocks, but in hindsight, I should have waited to then buy my ETF positions because late 2021 was the peak of the market, and thus I have a pretty high cost basis in most of these new positions. Okay, so with all that said, let's get into the meat and potatoes here. And let's begin with my best performing assets, and of course, that's in my income assets group. So this is the all-time view. I'm up 17% in Jetbeat and about 7% in Divo. And as I'm sure all you guys are aware of, in this most recent market downturn, the value plays have been performing the best, and that's exactly what these funds represent. But even so, a big reason why I'm not up even more in these positions is because, again, back in October, I bought even more shares. So Jetbeat is my biggest winner by far. They have an expense ratio of 0.35%, and their assets under management have been exploding, and now it's over $8 billion. They currently have a yield of 7.5%, and they have about 100 holdings. And Jetbeat curates its portfolio by selecting stocks from the S&P 500 index and uses a proprietary process to identify value stocks with a favorable risk-return characteristic. And that's one of the reasons why the performance of this ETF has been better in 2022 so far. And of course, to achieve that super high dividend yield Jetbeat has, they use ELNs. And I've gone in depth about the ELNs before on the channel, but essentially they're a more complicated version of a call option. And these are the top 10 positions in Jetbeat currently. The number one position with a weighting of over 2% is AbbVie, followed by Bristol Myers, United Health Group, Microsoft, Hershey, Coca-Cola. If you have any background knowledge on these companies, you know that all of them are extremely high cash flow positive companies with low debt and extremely high profits. And moving on, Divo was my second biggest winner, and there's a lot of similarities between this and Jetbeat. The expense ratio is a bit more at 0.55%, and the assets under management is also less, although still pretty significant at over $1 billion. Although a major difference here is that Divo focuses on only 20 to 25 potential outperforming dividend-paying stocks. And similar to the ELNs in Jetbeat, they have tactical covered calls to boost monthly income. And that monthly income is just shy of 5%. And these are the top 10 holdings in Divo, and you're going to notice a lot of similarities between this and Jetbeat in terms of the quality of companies here. The biggest real difference is that this is more concentrated, and that's why the weights in the top 10 is a lot more. Now, aside from the competitive price appreciation, a major factor of these investments is the monthly income. And we're currently looking at the dividend history from both Jetbeat and Divo within my portfolio, and it spans back all the way to June 4th of 2021. We can see how the payments started out relatively low at around 10-15 bucks per month, but now if we scroll up to the top, my most recent dividend payment from Jetbeat was $58.66. So needless to say, I'm a big fan of these two investments. I plan on holding them for a long time, adding to them, and collecting monthly dividends. Okay, so that's all the positive good news out of the way. But now let's get into all of the pain and suffering, which is probably what most of you guys want to see, and that's all within my growth assets. So to start, I have VUG, which is down over 11% since I bought it at a pretty inopportune time. But it gets worse. If I go into my convictions, we have 3 ETFs here: BST, IGV, and the RK ETF. These are all high risk, high return tech ETFs, and thus they've been getting slaughtered over the past couple of months. My two biggest losers are ARK and BST. The ARK Innovation Fund is by far my biggest loser, down 45%. And let me give you guys my updated opinion on the ARK Fund currently. So the performance has been terrible. A lot of people have been jumping ship, and the sentiment around investments tend to follow its price action. And speaking of the price action, this is pretty common within the market, and I've seen it a lot before, especially in the crypto market. So this ETF saw a huge bull run back in 2020 due to the pandemic and the lockdowns. It got really overextended, and then with the talks of rising interest rates, a potential recession, the price came crashing down to a more realistic level. And of course, the primary force behind this price action to the downside is rising interest rates. And currently the market is pricing in about 7. This of course is to combat inflation, and the general sentiment around inflation is that yes, it is currently high in the market, but this is probably around the peak. This is the worst it's going to get, most likely. So when you look at the price action of the ARK Fund, this line straight down represents people pricing in the higher interest rates, meaning that most of the pain is already behind us and the correction has largely already happened. And that's why whenever there's positive news that inflation might not be as bad as we predicted, the ARK Innovation Fund rebounds significantly. In fact, in the past 1 month, the ARK Fund is up over 18%, while the S&P 500 is up only 6%. So when it comes to this investment, in my opinion, you have to have a long-term outlook. The top position with a weight of almost 10% is Tesla. And of course, Tesla is a super solid company and they're crushing it in all departments. The companies within it, the technology, it is all quality in my view, but it did get overvalued back in 2020, and now with interest rates, it's putting more downward pressure on it. But as the companies within this ETF prove themselves, become more profitable, and interest rates kind of flatten out, the fears around inflation kind of go away, I think this fund will do a lot better in the future. And then my other big loser, of course, is BST. And this is very similar to the ARK Fund. It has a lot of science, technology, and innovative companies within it. In fact, the way I see it, the major difference between BST and the ARK Fund is that BST has a super high monthly dividend yield. So as you wait for the price appreciation to come back on your side, you get to enjoy a high level of monthly income. And with my greater approach of focusing on cash flow, that really fits into my strategy. So I definitely plan on holding BST into the future, and I might slowly sell some of my ARK Fund as it recovers and put that into BST, simply because there's a great amount of overlap between the two funds, but I prefer having a 7% dividend yield. But there you have it, guys. That's a look at my portfolio at the two biggest winners and losers. I hope you guys enjoyed the video, and I challenge you guys to leave a comment down below on both your biggest winner and loser that you invest in. But that's going to be the end of the video. Hope you guys enjoyed. If you did and you're still watching, I appreciate a like on the video, subscribing, and I'll see you guys in the next one.